On February 12, 2026, the Bitcoin Fear and Greed Index hit 5 out of 100. That is the lowest reading this index has ever recorded in its entire history. Let that sink in for a moment. Out of 2,940 daily readings since 2018, nearly 8 years of data, this week is the most fearful the market has ever been. Not just fearful, historically, record-breakingly fearful. I'm Adrian, and today I'm going to show you exactly what this moment means, what history says about what comes next, and the four-part framework that separates the investors who make life-changing money from this, from the ones who lock in their worst losses at the exact wrong moment. Before we look at history, you need to understand what this number actually measures. The Bitcoin Fear and Greed Index is not a gut feeling. It is not a poll. It is a mathematical formula built from 6 separate market signals. Volatility makes up 25% of the score, how violently Bitcoin is moving compared to its 30- and 90-day averages. Market momentum and volume make up another 25%. Are people buying aggressively or pulling back? Social media sentiment is 15%. How is the crowd talking about Bitcoin right now? Bitcoin dominance is 10%. When Bitcoin's share of the total crypto market rises, it means investors are fleeing risky altcoins and hiding in Bitcoin. Google Trends data is another 10%. How many people are searching for Bitcoin-related terms? And surveys make up the final 15%, direct sentiment from market participants. When all 6 of these signals collapse simultaneously, the index hits the floor. Right now, every single one of them is in the red. Now let's look at what history actually says about what happens after extreme fear. I pulled every single extreme fear reading, defined as below 20, from the full 8 years of data. There have been exactly 350 days where the index hit extreme fear territory. Those 350 days cluster into 5 distinct episodes. Let me walk you through each one. Episode 1, February 2018. The index hit 8. Bitcoin had just crashed from its all-time high of $20,000 and was sitting at around 8,000. Episode 2, March 2020. COVID shut down the global economy. The index crashed to 8. Bitcoin was at $4,500. Markets everywhere were in freefall. Episode 3, June 2022. The Luna stablecoin collapsed and wiped $40 billion from the market in 72 hours. The index hit 6. Bitcoin was at $17,500. Episode 4, November 2022. FTX, one of the world's largest crypto exchanges, collapsed overnight. The index dropped to 9. Bitcoin hit $16,000. Episode 5, that's right now. February 2026. The index just hit 5. An all-time low. Bitcoin is sitting at $68,000. Here is where the data becomes either terrifying or extraordinary, depending on which side of the trade you were on. After the COVID crash in March 2020, the fear and greed hit 8. Bitcoin was at 4,500. 90 days later, Bitcoin was at 9,000. That's plus 100%. 365 days later, Bitcoin was at 29,000. That's plus 544%. 13 months later, Bitcoin was at $60,000. That's plus 1,200% in just over a year. 1,200%. From extreme fear to a life-changing return. After the Luna collapse in June 2022, Bitcoin sat at 17,500. 1 year later, it was at 25,000. Not spectacular, but it held. 2 years later, it was at 68,000. That's plus 288%. After the FTX collapse in November 2022, Bitcoin was at 16,000. 90 days later, 22,000. Plus 37%. 1 year later, 35,000. Plus 119%. 2 years later, over $90,000. Plus 462%. The pattern is consistent. Extreme fear, followed by extraordinary recovery, for those with the patience to wait. But here's the thing that most people skip over, and it is critical. February 2018 was also extreme fear, and Bitcoin kept falling for another 10 months. From $8,000, it dropped all the way to $3,200 by December 2018. That is a 60% loss from the extreme fear reading. So why did extreme fear work in 2020 and 2022, but not in 2018? The answer is context. In 2018, Bitcoin had just come off its first truly mainstream all-time high at $20,000. The crash was a bubble deflating. There was no fundamental catalyst for recovery, just euphoric retail investors getting washed out over 18 months. In 2020, the crash was caused by an external shock, a global pandemic. The underlying market structure was not broken. The fear was rational in the moment, but temporary. In 2022, the crashes were caused by fraud and contagion. Luna was a scam. FTX was fraud. Again, external shocks, not structural Bitcoin failure. The lesson: extreme fear caused by external shocks is opportunity. Extreme fear caused by structural breakdown is a warning. Right now, Bitcoin is trading $68,000, 37% below its all-time high of $108,000. This is not a bubble peak. This is a mid-cycle correction. The fear is external: macro uncertainty, tariff wars, tech sector rotation, not a Bitcoin-specific structural failure. So how do you know whether extreme fear is an opportunity or a trap? Here is the exact framework I use. Check 1. Where is Bitcoin relative to its 200-day moving average? If Bitcoin is above the 200-day MA during extreme fear, the trend is still intact. The fear is emotion, not reality. Right now, Bitcoin sits at 68,000. Its 200-day moving average is at 63,000. We are above it. Check 1 passes. Check 2. Are long-term holders selling or accumulating? On-chain data tracks wallets that have held Bitcoin for more than a year. During structural bear markets, these wallets distribute, they sell into panic. Right now, long-term holder supply is increasing. They are buying this dip, not selling it. Check 2 passes. Check 3. Is Bitcoin dominance rising or falling? When Bitcoin dominance rises during fear, it means smart money is rotating from speculative altcoins into Bitcoin as a store of value. That is a flight to quality, not exit from crypto. Bitcoin dominance has been trending up through this episode. Check 3 passes. Check 4. What is the macro catalyst ahead? The Federal Reserve meeting schedule, CPI data, earnings seasons. These are the events that can flip sentiment fast. When macro fear resolves, the fear and greed index tends to snap back to neutral or higher within weeks. The next Fed meeting is weeks away. Any signal of easing is a potential ignition switch. Check 4. Watch closely. 3 out of 4 checks pass with a green light. 1 is pending. That is not a guarantee, but it is a historically significant setup. Let me put the full picture on the table. Bitcoin fear and greed index, 5 out of 100. All-time record low. Bitcoin price, $68,000. Bitcoin 200-day moving average, $63,000. Prices above. Distance from all-time high, 37% below. Not a peak. Long-term holder supply, increasing. Smart money is accumulating. Bitcoin dominance, trending higher. The episode duration, 22 consecutive days of extreme fear in February 2026. The longest sustained extreme fear episode since the 2022 bear market. You are sitting inside a historically rare market moment. There have been fewer than 10 days in 8 years that match today's fear level. Every prior episode in a bull market cycle resolved to the upside. Here is exactly what I am watching to confirm or deny this setup. The line in the sand is $65,000. If Bitcoin holds $65,000 on any pullback over the next 2 weeks, that tells me institutional buyers are defending the level. The floor is in. The setup is valid. If Bitcoin breaks below 60,000 with meaningful volume, the picture changes. That would suggest that 200-day MA support is weakening, and we reassess the entire framework. The secondary signal to watch is the fear and greed index itself. When it starts recovering from sub-10 readings back toward 20 or 30, that is the market telling you fear is fading. The move often begins before sentiment fully recovers. Watch for the index to cross 15 on consecutive days. That has historically preceded a meaningful price recovery within 30 to 60 days. Here is the bottom line. The Bitcoin Fear and Greed Index hit its all-time low this week, 5 out of 100. History says this is the kind of moment that, looked at 2 years from now, will either be remembered as one of the greatest buying opportunities of the cycle, or the moment you let fear make your decision for you. The data does not tell you what to do. That is your choice to make based on your own situation, your own risk tolerance, and your own research. But the data does tell you this. The investors who built the most wealth in crypto did not buy when it felt good. They bought when the data said the fear had overpriced the risk. Right now, the data is saying exactly that. I'm Adrian. If this gave you a sharper lens for reading market moments like this one, subscribe. I cover exactly these kinds of data-driven setups every week.